There's a moment in every financial collapse when the system doesn't scream. It cracks quietly, no alarms, no emergency headlines, no breaking news banners flashing red across your screen. Just a number changing, a number so boring that most people scroll right past it, a number so technical that it sounds irrelevant, a number so misunderstood that by the time it matters, it is already too late. That number is 3.5%. This is not a theory. This is not speculation. This is not fear-mongering. Japan's 30-year government bond yield just crossed 3.5%. And with it, something fundamental in the global financial system snapped. The world is watching the Federal Reserve. The world is watching elections. The world is watching wars. But almost no one is watching Tokyo. And that is exactly how every financial catastrophe begins. The butterfly that became a hurricane. In chaos mathematics, there's a concept called the butterfly effect. A butterfly flaps its wings in one part of the world, and weeks later, a hurricane forms somewhere else. In finance, this is not a metaphor. It is a mechanism. A small change in one market does not stay isolated. It propagates. It amplifies. It feeds on leverage. And Japan, for over 2 decades, has been the butterfly. But today, the butterfly is no longer flapping its wings. It is generating a storm. Why Japan matters more than anyone realizes. For the last 25 years, Japan has played a role no other country could. Japan became the global ATM. Zero interest rates, unlimited liquidity, endless yen. For decades, money could be borrowed in Japan almost for free. That borrowed money was then deployed across the world into U.S. equities, U.S. real estate venture capital, emerging markets, cryptocurrencies, corporate bonds, even government debt elsewhere. This strategy became known as the yen carry trade. It was not small, it was not niche, it was not optional. It became the hidden foundation of modern financial markets. The lie of safe money. Japanese government bonds were considered the safest paper on earth. Why? Because yields were dead, because volatility was non-existent, because the Bank of Japan promised, and explicitly, that rates would never rise meaningfully. For institutions, this was paradise. Borrow yen at near zero, convert it into dollars, buy higher yielding assets elsewhere, pocket the spread, repeat, scale, leverage. This trade didn't just grow, it metastasized. The number that changed everything. Then something happened. The 30-year Japanese government bond yield surged to 3.5%. The 10-year yield crossed levels not seen since 1999. These are not random fluctuations. These are not technical noise. These are regime changes. For the first time in a generation, Japan is no longer cheap money. The ATM is closed. And when the ATM closes, everyone who is feeding off it feels the pain instantly. Why 3.5% is not just a number. To the average person, 3.5% sounds harmless. To the institutional plumbing of the world, it is catastrophic. Because the entire system is built on assumptions that Japan would always cap yields, that funding costs would remain stable, that leverage could roll forever. Every hedge fund, every pension fund, every bank, every sovereign strategy that relied on Japanese funding now faces a brutal reality. Their cost of capital just exploded. This is how margin calls. Begin margin calls do not start with panic. They start with spreadsheets, a funding model updates, a yield curve shifts, collateral requirements change. Suddenly, positions that were safe are not safe anymore. Assets must be sold, not because investors want to sell, but because they have to. This is how liquidity disappears, not gradually, violently. The invisible leverage problem. The most dangerous leverage is the leverage you don't see. The yen carry trade is not transparently reported. It is embedded inside derivatives, FX swaps, repo markets, structured products. When yields spike in Japan, this leverage doesn't unwind politely. It snaps. And when it snaps, it forces liquidation across entirely unrelated markets. Stocks fall not because earnings are bad. Crypto crashes not because technology failed. Real estate freezes not because demand vanished. They fall because funding died. Why this moment is different. Japan has crossed a psychological and structural line. For 25 years, the Bank of Japan suppressed reality. For 25 years, it monetized debt at any cost. For 25 years, it told the world, rates will stay low forever. That promise is now broken, and once trust in the funding source breaks, it never comes back the same way. The first domino. This yield breakout is not the crisis. It is the trigger. The first domino in a chain reaction that runs through currency markets, bond markets, equity markets, commodities, precious metals, and most importantly, liquidity itself. When liquidity vanishes, price discovery becomes brutal. Why almost no one is talking about this? Because this story is boring until it isn't. It doesn't fit into headlines. It doesn't trend on social media. It doesn't come with dramatic explosions. It comes with a yield chart. And by the time that chart reaches the front page, the damage is already done. The silence before the unwind. Right now, markets still look functional. Indexes are still standing. Volatility is still contained. Most investors still believe this is manageable. That belief is exactly what exists before every liquidity shock. The system does not break where it is strongest. It breaks at the weakest link. In Japan, the global ATM just shut its doors. The system. No one sees. Every financial crisis has a visible villain. In 2008, it was subprime mortgages. In 2020, it was a virus. In 2022, it was inflation and rate hikes. But behind every visible shock, there's always an invisible mechanism doing the real damage. Right now, that mechanism is the yen carry trade. Most people have never heard of it. Most investors underestimate it. Most commentators oversimplify it. Yet this single trade has quietly underwritten global asset prices for more than 2 decades. And now it is unwinding. What the yen carry trade really is, at its core, the yen carry trade is deceptively simple. Borrow money in a currency with very low interest rates. Convert that money into a currency with higher returns. Invest it in assets that yield more than the cost of borrowing. Collect the difference. For years, no currency on earth was cheaper to borrow than the Japanese yen. 0 rates, sometimes negative rates, unlimited liquidity. Japan offered the world something no one else would. Free money with no consequences. Or so it seemed. How it became a monster. What started as a conservative strategy slowly transformed into a global addiction. Banks used it, hedge funds used it, pension funds used it, insurance companies used it, sovereign wealth funds used it. The trade grew not just in size, but in complexity. It was no longer just borrow yen, buy US bonds. It evolved into FX swaps, interest rate differentials, structured leverage, derivatives layered on derivatives. The yen became the base currency of global leverage. The critical assumption. Every carry trade depends on one thing staying true. Funding costs must remain stable. As long as Japanese yields stayed near 0, the trade worked. As long as the yen stayed weak, the trade worked. As long as volatility stayed suppressed, the trade worked. Japan promised all 3. For decades. Markets trusted that promise. That trust is now breaking. Why a rise in Japanese yields is toxic. When Japanese bond yields rise, 3 things happen simultaneously. Borrowing costs increase. The yen strengthens, risk models break. This is the nightmare scenario for carry traders because suddenly debt becomes expensive. Currency losses appear. Leverage turns against you. And when leverage turns, it doesn't ask for permission. The role of the Bank of Japan. The Bank of Japan did not just allow the carry trade, it engineered it. Yield curve control, YCC, was the policy that guaranteed artificially low long-term rates. Unlimited bond buying suppressed volatility. This policy turned Japan into a funding factory for the world. But suppressing reality always has a cost, and that cost compounds over time. The breaking of yield curve control. When Japan's 30-year yield surged to 3.5%, it wasn't just a market move, it was a policy failure. It signaled that the BOJ is losing control. Inflation pressures or real bond vigilantes are back. Once long-term yields break free, credibility evaporates. And without credibility, central banks lose their most powerful weapon. How leverage actually unwinds. Unwinding does not happen in headlines. It happens in margin systems. A prime broker recalculates risk. Haircuts increase. Collateral requirements rise. Credit lines tighten. Funds are forced to reduce exposure. Not because they want to, because they must. The selling spreads outward like a shockwave. Why U.S. markets are not safe. There's a dangerous belief that U.S. markets are insulated. They are not. The S&P 500 is propped up by cheap leverage buybacks funded by debt. Global capital flows. Much of that capital was indirectly funded through Japan. When Japanese funding tightens, U.S. liquidity tightens. There is no firewall. The feedback loop. Here is where things accelerate. Japanese yields rise, carry trades, lose profitability, positions are reduced, asset prices fall, volatility rises, risk models force more selling. This loop feeds on itself. It does not stop because markets want it to stop. It stops only when forced liquidation is complete. Why this time is different from before. Japan has flirted with higher yields before, but this time the context is deadly. Global debt is at record levels. Leverage is higher than ever. Central banks are already stretched. There's no cushion, no margin for error. The global ATM is closed for 20 years. Japan financed the world's excesses, cheap credit, asset inflation, speculation disguised as investment. Now the cost of that credit is rising. The ATM is no longer dispensing free money, and everyone who depended on it is scrambling. The silent panic inside institutions. Publicly, everything looks calm. Privately, risk committees are in emergency mode. Exposure is being reviewed. Stress tests are being rewritten. Worst-case scenarios are being modeled. Because they understand something retail investors don't. This is not a localized issue. It is systemic. Why liquidity is the real story. Markets don't crash because of bad news. They crash because liquidity disappears. Liquidity comes from leverage. Leverage comes from cheap funding. Cheap funding came from Japan. Now that source is drying up. And when liquidity dries up, prices gap violently. The previous warnings. No one listened to history, tried to warn us. 1998, LTCM collapse. 2008, global funding freeze. 2020, repo market stress. Each time, the same pattern appeared. Leverage cheap funding. Sudden repricing, Japan was always in the background. This time, it is at the center. The emerging safe haven shift. When leverage unwinds, capital seeks safety, but not paper safety, not bonds that can be devalued, not currencies that can be printed. It seeks assets with no counterparty risk. This is where the story quietly begins to pivot. Why paper assets are vulnerable. Stocks depend on earnings and multiples. Bonds depend on trust in issuers. Currencies depend on central banks. In a funding shock, all three are questioned simultaneously. That is when investors rethink what safe really means. The unseen cracks are widening. Right now, this unwind is still early. Positions are being reduced, not dumped. Liquidity is thinning, not gone. Confidence is eroding, not shattered. But the direction is set. Once funding breaks, it does not heal overnight. The system is no longer balanced for decades. Cheap money masked inefficiency. Zombie companies survived. Bad investments were refinanced. Risk was mispriced. Rising Japanese yields are exposing all of it. This is not a correction. It is a recalibration. The calm before the real stress. Most people will realize what happened only after markets reprice. They will look back and ask, how did we miss this? The answer will be simple. They weren't watching Japan. When markets don't fall, they gap. Financial crises rarely unfold the way people expect. They don't begin with screaming headlines. They don't start with chaos on trading floors. They don't announce themselves in advance. They begin quietly, inside balance sheets. A margin call is not panic. It is mathematics, and mathematics does not negotiate. When funding costs rise and asset values fall at the same time, leverage stops being a tool and becomes a weapon. This is the phase the global system is now entering. What a global margin call really means. A margin call is often misunderstood as something that happens to reckless traders. In reality, margin calls happen to the entire system. Banks post collateral. Funds post collateral. Corporations post collateral. Governments post collateral indirectly through markets. When asset prices drop or volatility spikes, the required collateral increases. Suddenly, cash is demanded, assets must be sold, liquidity must be raised. Not tomorrow, not next week, immediately. Why this time the margin call is global. In past crises, stress was localized. Housing in 2008. Emerging markets in the 1990s. Tech stocks in 2000. This time, the pressure point is funding itself. The Japanese yield spike hits FX markets, bond markets, equity markets, derivatives, repo markets, all at once. There's no isolated pocket of safety. The role of derivatives. The invisible multiplier. Most leverage today does not appear on balance sheets. It lives inside derivatives. Interest rate swaps. Currency forwards, options, total return swaps. These instruments amplify small moves into massive exposures. A 1% move in yields can translate into billions in losses. When Japanese yields surged, derivative pricing models changed instantly. Margin requirements were recalculated across the globe. This is how stress spreads faster than headlines. How liquidity really disappears. Liquidity is not money. Liquidity is confidence that you can sell something when you need to. In a margin event, buyers step back. Bid, ask, spreads widen. Market depth collapses. Prices don't drift lower. They fall through air pockets. This is why markets gap down instead of gradually correcting. The false comfort of strong markets. Many investors look at index levels and feel reassured. The S&P 500 is still standing. Volatility still looks manageable. Credit spreads haven't exploded yet. This is a dangerous illusion. Liquidity does not vanish evenly. It retreats from the edges first. Small caps, emerging markets, high yield credit, speculative assets. By the time it reaches the center, it's already too late to react. Why banks are quietly retreating. Banks are not panicking. They are doing something far more dangerous for markets. They are de-risking. Credit lines are being reviewed. Counterparty exposure is being reduced. Haircuts are being increased. This is rational behavior for banks. It is catastrophic for leveraged markets. Because when banks pull back, liquidity vanishes without warning. The dollar liquidity squeeze. When global stress rises, something predictable happens. Demand for dollars surges. Why? Because dollar debt must be serviced. Dollar collateral is required. Dollar funding becomes scarce. As yen-funded positions unwind, capital rushes toward dollars. This strengthens the dollar and tightens financial conditions everywhere else. A stronger dollar is not bullish. It is a sign of stress. How this hits? Emerging markets. First emerging markets depend on foreign capital, dollar liquidity, stable funding. When funding costs rise, these markets bleed first. Currencies weaken. Bond yields spike. Capital flees. This is not speculation, it is structural. Emerging markets are the shock absorbers of global finance, and shock absorbers break first. Why corporate debt is a time bomb. Years of cheap money encouraged corporations to load up on debt. Refinancing was easy. Interest costs were manageable. Risk was ignored. Now, rates are higher. Credit conditions are tightening. Refinancing is uncertain. Companies with weak balance sheets will not survive a liquidity shock. Defaults don't happen all at once. They cascade. The illusion of central bank control. Many believe central banks can simply step in. This belief is outdated. Central banks are trapped. Inflation limits easing, credibility limits intervention, debt limits flexibility. They can slow a crisis. They cannot stop a funding unwind already in motion, especially not one originating outside their jurisdiction. Why bonds are no longer safe? In previous crises, bonds were protection. This time, bonds are part of the problem. Rising yields mean falling prices. Inflation erodes real returns. Sovereign debt levels are extreme. When both stocks and bonds fall together, traditional portfolios break. This forces institutional investors to rebalance aggressively. The selling. No one sees coming. Forced selling does not announce itself. It appears as portfolio adjustments, risk reduction, volatility management. But the effect is the same. Assets are sold regardless of price. This is why correlations move toward one. Everything becomes connected in a liquidity event. Why paper? Wealth is vulnerable. Paper assets rely on trust. Trust in issuers, trust in markets, trust in liquidity. When trust erodes, paper wealth evaporates quickly. Stocks can be repriced overnight. Bonds can be repriced instantly. Currencies can be devalued with a policy decision. This fragility is exposed during funding shocks. The psychology of the unwind. At first, denial dominates. It's contained. It's temporary. It's already priced in. Then concern creeps in. Liquidity thins. Volatility spikes. News turns cautious. Finally, fear takes over. At that point, exits are crowded. Why this is not a normal correction. Corrections reset valuations. Liquidity shocks reset systems. They expose hidden leverage, bad assumptions, structural fragility. This is not about earnings or growth. It is about whether the system can fund itself. The weak links are being tested. Every system has weak links. Highly leveraged funds, illiquid assets, overextended balance sheets. The Japan yield shock is stress testing all of them simultaneously. Some will fail quietly, others will fail loudly. The speed problem. Modern markets move faster than ever. Algorithms react instantly. Risk models update continuously. Capital flows shift in seconds. There's no pause button. By the time humans understand what is happening, markets have already moved. Why most people will misunderstand this? They will look for a headline event, a crash, a default, a policy announcement. They won't realize the damage was done earlier, when funding cracked. This is how systemic crises hide in plain sight. The core truth: markets do not run on optimism. They run on liquidity. Liquidity does not come from confidence. It comes from cheap funding, and the cheapest funding source in the world just broke. The system is adjusting violently. This adjustment is unavoidable. Years of distortion are being unwound. Years of mispricing are being corrected. Years of leverage are being reversed. The process is not smooth. It never is. This is what real risk looks like. Real risk is not volatility. Real risk is illiquidity. And illiquidity is spreading, quietly, relentlessly, mathematically. When capital stops believing every financial system runs on belief, belief that money will hold value, belief that contracts will be honored, belief that liquidity will be there when needed. When that belief cracks, capital behaves differently. It doesn't argue. It doesn't wait. It moves. What is unfolding now is not a market event. It is a capital migration. And history shows that when capital migrates, it leaves devastation behind. The final stage of a liquidity crisis. Liquidity crises follow a pattern. First, funding tightens, then leverage unwinds, then forced selling begins. The final stage is something far more profound. Capital abandons paper promises. This is the stage most investors misunderstand because it looks calm on the surface. Prices still move. Markets still trade. Institutions still function. But underneath, confidence has shifted. What paper assets really mean? Paper assets are claims. Stocks are claims on future earnings. Bonds are claims on future repayment. Currencies are claims backed by policy and trust. None of these are tangible. They exist because we collectively agree they do. In normal times, that agreement is strong. In funding shocks, that agreement weakens. And when it weakens, capital looks for something else. The historical pattern. No one escapes. This is not new. Every major financial reset follows the same arc. Excess leverage builds. Funding costs rise. Trust erodes. Paper assets are questioned. Capital seeks refuge. The names change. The instruments change. The psychology does not. Why central banks can't save this phase. Central banks excel at confidence management. They can provide liquidity, lower rates, offer guarantees, but they cannot force belief. When capital no longer trusts the system, intervention loses effectiveness. Printing money does not restore confidence. It often accelerates the flight. The paradox of intervention. The more aggressively authorities intervene, the clearer the signal becomes. Something is wrong. Emergency measures reassure no one who understands history. They confirm fear. The weakest link always breaks first. Systems do not collapse evenly. They break at the weakest point, not the largest market, not the loudest asset, the weakest structure. This can be over-leveraged financial institutions, illiquid bond markets, currency pegs, shadow banking structures. Once the weakest link snaps, stress propagates instantly. Why Japan was the anchor, and why its failure matters for decades, Japan was the stabilizer. Low rates, predictable policy, suppressed volatility. It absorbed excess leverage from the global system. Now that anchor is lifting. When the anchor lifts, everything floats, uncontrollably. Capital does not seek returns in crises. In normal markets, capital chases yield. In crises, capital seeks survival. Return becomes secondary. Preservation becomes primary. This is where narratives change. Speculation loses appeal. Growth stories fade. Liquidity and tangibility dominate. The silent repricing of risk. Risk is being repriced across dimensions people don't watch. Counterparty risk, settlement risk, sovereign risk, policy risk. These risks don't show up in earnings reports. They show up in capital flows. Why this shift is hard to see in real time. Most people look at prices. Professionals look at flows. Flows tell the real story. When capital quietly exits paper markets, prices may not collapse immediately, but liquidity thins. Depth vanishes. Fragility increases. This is the calm before repricing accelerates. The role of silver and hard assets. In this phase, throughout history, when trust in paper weakens, capital turns toward assets with three characteristics. No counterparty risk, no default risk, no dependency on policy. Silver fits this profile uniquely. It is not someone else's promise. It cannot be printed. It exists outside the financial system. This is why it behaves differently during liquidity crises. Why silver is not just a commodity. Here silver is both, a monetary metal, an industrial input. This dual nature creates a pressure imbalance. As capital seeks safety, investment demand rises. As systems strain, industrial demand does not vanish. Supply does not adjust quickly. This asymmetry matters. The mistake of looking at price alone. Price lags reality. By the time price confirms stress, positioning has already shifted. What matters is availability inventory. Physical flows. Paper representations of assets break down during systemic stress. How paper markets lose control. When physical demand diverges from paper supply, markets fracture. This has happened before. Paper prices become disconnected from reality. Delivery risks increase. Confidence erodes further. This is how control is lost. The rejection of financial engineering. For decades, financial engineering replaced fundamentals. Derivatives replaced ownership. Leverage replaced savings. Complexity replaced transparency. Liquidity shocks reverse this trend. Simplicity regains value. Ownership matters again. Why this is not a trade, but a transition. Many will try to trade this environment. Most will fail. This is not a short-term event. It is a structural transition. From excess leverage, artificial pricing, Central bank dominance. 2, scarcity, volatility, decentralized trust. Transitions are messy. The emotional phase of the reset. At first, disbelief. This can't be happening. Then anger. Someone should fix this. Then fear. I need out. Finally, acceptance. This system is changing. Markets reflect psychology. Why wealth gap widens during this phase. Those who understand liquidity move early. Those who trust narratives move late. Early movers preserve capital. Late movers absorb losses. This is how resets redistribute wealth. Quietly. The failure of diversification. Traditional diversification assumes correlations break. In liquidity crises, correlations converge. Stocks fall together, bonds fall together, risk assets fall together. Diversification fails when it is needed most. What survives? Systemic stress. What survives is not complexity. What survives is simplicity, tangibility, independence. Assets that do not rely on someone else's solvency endure. Why this is a moment of truth. This is not about Japan alone. Japan was the trigger. The system was already fragile. Excess debt, excess leverage, excess confidence. The yield breakout simply revealed reality. The final illusion that will shatter. The illusion that markets are controlled. They are not. They are managed until they aren't. Once control is lost, policy follows markets, not the other way around. The long unwind has begun. This is not a crash in a day. It is a process. Funding tightens, trust erodes, capital migrates. Each stage feeds the next. Why most people will misread the end, they will look for closure. A bottom. A rescue. A declaration that the worst is over. Systems don't end cleanly, they morph, and those who don't adapt are left behind. The real story of the Japan shock. The Japan shock was never about yields. It was about belief. Belief that cheap money would last forever. Belief that leverage had no cost. Belief that central banks controlled reality. That belief is breaking. When history looks back, history will not remember a headline. It will remember a shift. The moment when the global ATM closed. The moment when funding cracked. The moment when capital stopped trusting paper. This is how systems reset. Not with explosions, with silence, with capital moving quietly, with liquidity disappearing invisibly, with belief evaporating slowly. Until suddenly, it's obvious. The final truth. Markets don't collapse because of fear. They collapse because of mathematics. And mathematics does not care what anyone believes.